Welcome to the deep dive. Today we are talk tickers, and we're really getting into the Q2 fiscal year 2026 earnings call for Park Aerospace Corp.
Yeah.
That call happened back on October 9th.
Yeah, and if you glanced at the materials, the call itself was pretty dense, long presentation, and management overwhelmingly positive, especially about their strategy.
Right, but then you look at the market.
Exactly. The reaction was, well, brutal. A big sell-off, high volume too. So our mission today is to cut through all that noise, figure out the financial details that may be spooked investors near term, and see if the market's missing like a real long-term defense story here.
That's the key paradox, isn't it? You've got solid execution, but the market just punishes the stock. It really needs unpacking. Because, on paper, Park delivered pretty much exactly what everyone expected. They even hit the high end of their own profitability framework.
Okay, so let's run through those top-line numbers quickly.
Sure. So Q2 GAAP and adjusted EPS, they landed right on the consensus mark, $2.12.
Revenue was $16.38 million. Now, that's actually up nicely sequentially, about 6.4%, even if it was down just a tiny bit year over year.
And profitability.
That was the real strength. Adjusted EBITDA came in strong at $3.4 billion. That's a 20.8% margin.
Yeah.
Like I said, comfortably at the top end of their prior guidance. Net income was $2.4 billion.
And crucially, the balance sheet, it looks pristine.
Absolutely pristine. Over $61.6 million in cash and marketable securities. And zero long-term debt, none.
So they've got the cash to make moves, offensively even.
Exactly. So you have this picture, right? A company hitting its targets, bulletproof balance sheet, executing the plan. But the stock dives over 5% right after the call.
Wow.
And that tells you everything. The investors just completely shrugged off the Q2 results. They're laser focused on, well, what they see as near-term revenue wobbles, those product mix issues, and maybe just a lack of clarity on when the big growth really kicks in.
Seems like they think the immediate future is just too messy.
That's a good way to put it. Messy.
Okay, let's dig into that messy part then, because it sounds like it really centers on this product mix and the margins. Gross margin, you mentioned it improved year over year.
Yeah, significantly. Up 270 basis points to 31.2%, which sounds great.
But
management was clear. The margin performance was still being held back.
Yeah.
And it was basically one thing. The sheer amount of this Raycarb C2B fabric they were selling.
The C2B fabric. Okay, explain that.
Right. This is the critical near-term headwind we need to understand. They sold $1.65 million worth of just the raw fabric in the quarter.
Raw fabric.
Raw fabric. And the key thing, the reason it drags down the overall margin is that they sell this stuff with just a tiny markup. It's almost a pass-through.
Wait, but hold on. That sounds weird. If they're experts in the high-margin stuff, the ablative materials made from the fabric, why sell so much of the low-margin raw material itself?
Well, that's where you get this fascinating signal from the defense side. Management basically said defense OEMs are just buying it up, stockpiling the raw C2B fabric aggressively. So the ratio is totally out of whack right now. Normally, Park would take that fabric, convert it into the high-margin ablative composites, the complex shielding stuff they're known for.
Right.
And management confirmed the margins on those converted materials are, quote, very, very good.
Okay, so the fact that OEMs are hoarding the raw fabric, it's actually a sign of huge future demand urgency.
Exactly. It signals immense supply urgency down the line, but right now it temporarily dings Park's reported gross margins.
So the near-term pain is actually a long-term gain signal. That's a powerful irony. The market clearly missed that in the panic.
Completely missed it. But the good news is there was an update on fixing this imbalance.
The operational update.
Yeah, there's been this kind of operational bottleneck going on for a while. A key customer had this C2B fabric requalification process.
Okay.
Management said that's now about 90% complete.
90%, that's huge.
It's a major hurdle cleared. It means that specific program can get back to, quote, normal production levels.
And the last 10%?
They expect that to wrap up within 9 to 12 months. So, yeah, the takeaway is that the operational risk is dissolving.
Which should mean a better product mix soon. More high-margin converted stuff, less raw fabric.
That's the idea. Lifting gross margins in the coming quarters.
Okay.
And that resolution is really important because it clears the path for the massive opportunity ahead, what management calls the defense-led thesis.
Right, the defense store.
This is the real narrative they want investors focused on. It's less about temporary contracts and more about a big geopolitical shift.
Okay, let's talk about the scale of this defense demand. It's driven by restocking missile systems.
Primarily. Think global conflicts depleting stockpiles. They specifically mention programs like the PAC-3 Patriot missile system. That's the big driver.
And Park's role there?
They are the sole source qualified supplier for the specialty ablative materials on the Patriot.
Wow.
Sole source.
Wow.
And the demand surge is just monumental. The Department of War is pushing suppliers to quadruple production rates.
Quadruple.
4 times, targeting 2,000 missiles per year. And Park specifically has been asked to ramp up its output by significant orders of magnitude.
Okay, significant orders of magnitude. That requires capacity. Which brings us to the big money item, the CapEx plan.
Exactly. Management isn't just talking the talk. They're putting serious money behind this. A major U.S. facility expansion.
Oh, major.
The budget estimate has gone up. It's now $40 million to $45 million.
$40 to $45 million. Wait, how much cash did you say they had?
About $61 million.
So they're committing something like 65% to 75% of their current cash to this one expansion.
Yep. This isn't just a casual investment. This is a huge, high-confidence bet. They're going almost all in on this defense opportunity.
They must see this demand as incredibly durable then.
Well, they literally called it seizing once-in-a-lifetime opportunities, and they said the time to act is now. The fact the budget increased, needing another manufacturing line, tells you the initial estimates just weren't big enough for the scale of Patriot components needed.
So this capacity build, this is the real long-term inflection point for the company's revenue.
That's the thesis, absolutely.
And they're also shoring up the raw material supply chain internationally.
Right, the Ariane Group partnership over in France. Park advanced about $6 million to help them install new C2B fabric manufacturing equipment there.
Okay.
And interestingly, they're also funding a joint study to look at potentially further increasing C2B capacity, presumably here in the U.S.
So they're thinking even the $45 million expansion might not be enough eventually.
It suggests they're planning for a scenario of truly massive, sustained global defense demand.
Oh, okay. Let's round out the picture. We have to touch on commercial aerospace, too. That's still a big part of their long-term plan.
Yeah.
How did that look in Q2?
Yeah, the commercial side gives that long-term visibility. Q2 GE Aerospace program sales were $7.5 million, and they updated the full fiscal 26 estimate slightly to between $27.5 and $29 million.
And the big volume driver there is still the Airbus A320neo.
Oh, yeah. The backlog is huge. Over 7,000 firm aircraft orders. Park supplies materials for the CFM LEP-1A engine, which is something like 64.7% market share on those firm engine orders.
So the volume is basically guaranteed long-term.
Guaranteed. But, the short-term ramp, it's still frustratingly slow.
Still dealing with supply chain issues.
Primarily the engine's supply chain bottleneck, yeah. Airbus wants to hit 75 deliveries a month, but they're stuck around 50 to 55 right now.
Is there any light at the end of that tunnel?
Well, the good news is those engine constraints are reportedly getting better. And Airbus is serious about the ramp. They're opening new final assembly lines, FALs, in the U.S. and China to hit that 75 a month rate by 2027.
So that build-out shows commitment, which means more demand for Park over the next few years.
Definitely. A huge increase baked in over the next 3-4 years.
Okay, what about the wide-body side? Boeing and the 777X. Park supplies the GE9X fan case material there, right?
They do. But that program is hitting, turbulence. Its certification looks like it's slipping past the late 2025, early 2026 target.
Why the delay?
It sounds like it's down to, quote, increasingly deliberate FAA scrutiny.
The post-MAX effect.
Seems like it. It's not just a 777X issue. It reflects this tougher regulatory environment. The FAA is just taking longer, being more granular. Specifically, they mentioned delays getting the type inspection authorization, the TIA. That holds up flight testing.
So that regulatory friction, it probably means all commercial ramps might be slower than planned historically?
It certainly suggests that, yeah, which, reinforces why that immediate, urgent defense ramp is so critical for Park right now.
Good point. And finally, quickly, the Chinese plane, COMAC C919.
Right, uses the LAAP-1C engine. Delivery targets for 2025 look shaky, probably won't hit them. But the interesting bit is confirmed interest from non-Chinese airlines. Air Asia, for example.
Meaning
COMAC is likely going for international certification, which could, long-term, set up a third major commercial jet program for Park to supply.
Okay, so this brings us right back to that split, doesn't it? You've got this unavoidable long-term commercial growth, plus this massive defense commitment versus the immediate margin pain and market skepticism.
Precisely.
All right, this is Talk Tickers, and now it's time for our segment. This is not financial advice. Let's workshop a trade idea based purely on this earnings call data. Imagine pitching this to an investment committee.
Okay, let's do it. My pitch starts by acknowledging the obvious, the market's near-term skepticism. That sell-off proves it. Investors are fixated on the margin headache despite this really robust long-term defense story and the huge CapEx commitment.
So you're saying there's an information gap to exploit?
Exactly. The market is pricing the short-term volatility, the C2B mix issue, not the sort of certainty of government-backed sole source demand that requires a massive factory expansion.
Okay, so how do we play that? How do we capture that defense upside but maybe sidestep some of the near-term margin choppiness?
Well, the idea would be to initiate an asymmetric long position, but targeting further out, say the second half of calendar year 2026.
Why then, specifically?
Because that timing lines up with two key potential catalysts converging. First, you should have the full resolution of that C2B requalification mess, which means margins should naturally expand and become more predictable.
Okay, the mix headwind resolves.
Right. And second, maybe more importantly, that's when we should start seeing the first real concrete results from that huge $40 to $45 million U.S. facility expansion. Material drawdowns, initial capacity actually coming online, maybe the first revenue contribution.
Got it. So how would you structure the trade to capture that?
Given the conviction in that long-term inflection, but acknowledging the timing risk, you'd want something with leverage. So purchase deep in the money, long-dated call options. EAPS, basically.
Deep ITM calls.
Yeah.
Why those?
Because they give you significant upside exposure if the stock moves strongly, capturing that moment when defense revenues really start reflecting that fourfold Patriot missile production increase. But with a defined risk, the trade lives or dies on management executing that capacity build-out on schedule. It's a pure bet on execution by a sole source, mission-critical supplier that just pushed 70% of its chips onto the table for this geopolitical opportunity.
A high-stakes bet on execution meeting opportunity. Compelling pitch. Okay, let's recap the key takeaways from this deep dive then. First, Q2 execution. It was solid. Profitable, hit the high end of their own estimates.
Yep, the market pain, the sell-off, that stemmed almost entirely from that temporary margin drag tied to the C2B fabric mix. Yeah. But that normalization, that fix, is already well underway, 90% done on the requalification.
Right, so that headwind looks temporary. And the undisputed long-term story, the reason for that huge, near $45 million expansion, is that defense-led thesis, driven by what management themselves are calling once-in-a-lifetime opportunities in missile rearmament.
Absolutely, that's the core narrative.
So management sounds supremely confident. They're making a really aggressive, almost all-in bet, using that strong balance sheet to capture this defense wave, but the market reacted with a steep sell-off. Which leaves you, the listener, with a provocative question to think about. Given Park Aerospace's financial strength and its sole source position on these critical defense programs, is the current stock price reflecting that strategic confidence and the sheer scale of the commitment? Or is the market being incredibly short-sighted, just fixated on that temporary margin volatility? That's all for this deep dive. Thank you for tuning in. We encourage you to continue exploring the material.